something strange is happening in the housing market. Homes are still listed. Agents are still holding open houses. Sellers are still hopping for bidding wars. But the buyers, they're quietly disappearing. And for many sellers, the realization comes slowly and then all at once. A home sits on the market for 2 weeks. Then 3. Showings slow down. The offers never arrive. The silence becomes impossible to ignore. Buyers are walking away. Not in panic, not in chaos, but in a slow, deliberate retreat. And if you look closely at history, you'll notice something important. This has happened before. To understand what's happening today, we have to go back. Back to another moment when the housing market felt unstoppable. The early 2000s. At the time, the narrative was simple. Real estate only goes up. Banks were lending easily. Investors were buying multiple properties. Home prices were rising faster than incomes. And many believed the trend would never end. But beneath the surface, cracks were forming. Affordability was shrinking. Debt was expanding. And buyers were stretching themselves further than ever before. Then something changed. Buyers stopped rushing in. And when buyers disappear, the entire market begins to shift. Today, the signs look familiar. Home prices surged dramatically between 2020 and 2022. Low interest rates fueled a buying frenzy. Millions of people rushed to secure homes before rates increased. Investors flooded the market. Demand felt endless. But the environment that created that demand has changed. Interest rates rose rapidly. Mortgage payments doubled for many buyers. Suddenly, the same house required hundreds or even thousands more per month. And buyers began asking a simple question. Is it still worth it? For many, the answer is no. This is the moment when psychology changes. Housing markets are driven by something powerful. Expectation. When buyers believe prices will keep rising, they rush in. But when they begin to believe prices might fall, they wait. Waiting becomes the safest strategy. Why buy today if the same house might be cheaper next year? Why compete in a bidding war if sellers may soon start cutting prices? These questions spread quietly across the market. And slowly, buyer demand fades. Real estate professionals are beginning to notice the shift. Open houses that once attracted dozens of visitors now see only a handful. Online listing views decline. Sellers start adjusting their expectations. First comes a small price cut, then another. But price reductions often create a new problem. They signal weakness. And buyers watching from the sidelines notice immediately. If sellers are lowering prices now, maybe they'll lower them even more later. So buyers keep waiting. This waiting game is one of the most powerful forces in real estate. Because housing markets move slowly. Unlike stocks, homes don't trade instantly. Transactions take weeks or months, which means shifts in demand take time to appear in official data. But on the ground, the change can be felt much earlier. Agents feel it first, then sellers, and eventually everyone else. In many markets today, inventory is quietly growing. Homes that would have sold within days now remain available for weeks. And when supply rises while demand falls, the balance of power changes. Sellers lose their advantage. Buyers gain leverage. But here's the twist. Even though buyers have more power, many are choosing not to use it. They're stepping back entirely. And that absence is reshaping the market. The reasons behind this shift are not mysterious. They are rooted in simple economics. Housing affordability in many cities has reached historic extremes. For decades, the relationship between income and home prices followed a pattern. But recently, that balance broke. Home values surged far faster than wages. Mortgage rates climbed sharply. And suddenly, the math stopped working for many households. The same buyers who once stretched to afford homes are now facing an uncomfortable reality. They simply can't justify the cost. So they walk away. But affordability isn't the only factor. There is another powerful force influencing buyer behavior. Uncertainty. Economic uncertainty. Job uncertainty. Market uncertainty. When people feel unsure about the future, they delay major financial decisions. And buying a home is often the biggest financial decision anyone makes. If there is even a small fear that the market could weaken, many buyers choose patience. This patience is changing the rhythm of the housing market. In hot markets, urgency drives activity. Buyers rush to make offers. Decisions happen quickly. But when urgency disappears, the market slows dramatically. Buyers take their time. They negotiate harder. Or they simply step aside and watch. And that's exactly what we're beginning to see. But the story doesn't end here. Because when buyers walk away, something else begins to happen. Sellers grow anxious. Price cuts accelerate. Inventory builds. And slowly, the balance that once supported rising prices begins to weaken. It's a process that unfolds quietly at first, almost invisibly, until suddenly, everyone realizes the market has changed. And in the next part of this story, we'll explore something even more revealing. Where buyers are disappearing the fastest, which cities are feeling the shift first, and why certain markets may face the greatest pressure ahead. Because when buyers walk away, some places feel the impact far sooner than others. When housing markets change, they rarely shift everywhere at the same time. Some places feel the pressure first. Others take longer. And the difference often comes down to a few critical factors: price growth, investor activity, and affordability. When all three rise too quickly, the market becomes fragile. That fragility is starting to show. During the housing boom of 2020 and 2021, certain cities experienced extraordinary price growth. Homes that once sold for modest prices suddenly doubled in value. Remote work played a major role. People left dense urban centers and moved toward suburbs and smaller cities. Demand surged almost overnight. Buyers from expensive coastal regions entered new markets with far greater purchasing power. Local buyers struggled to compete. Bidding wars became routine. And sellers quickly learned they could push prices higher and higher. But when price growth happens too fast, it often creates a dangerous imbalance. Because incomes rarely grow at the same speed. Eventually, a market reaches a point where local buyers simply cannot keep up. And when the flow of outside buyers slows, demand collapses. This pattern has appeared many times throughout real estate history. One of the clearest examples occurred during the housing bubble before the financial crisis. Cities like Las Vegas, Phoenix, and parts of Florida experienced explosive growth in the early 2000s. Investors flooded those markets. Speculation drove prices upward. But when buyers finally stepped back, those same cities experienced some of the steepest price declines in the country. History doesn't repeat perfectly, but it often rhymes. And today, similar conditions are beginning to appear again. In many fast-growing markets, inventory is rising quickly. Homes are staying listed longer. Price reductions are becoming more common. And real estate agents are noticing something that once felt impossible. Buyers are negotiating again. Just a few years ago, buyers had almost no leverage. Offers had to be aggressive. Inspections were waived. Contingencies disappeared. But today, the balance is shifting. And that shift changes behavior. When buyers sense the market weakening, they move cautiously. They study listings carefully. They compare prices. They wait for better opportunities. And sometimes they wait long enough that the deal never happens at all. For sellers, this creates a frustrating reality. The strategies that worked during the boom no longer work today. Listing high and expecting multiple offers often leads to disappointment. Homes sit longer. Momentum fades. And the market becomes slower and quieter. But another powerful force is shaping this moment. Interest rates. Mortgage rates are one of the most important drivers of housing demand. When rates fall, monthly payments shrink. Homes become more affordable. More buyers enter the market. But when rates rise, the opposite happens. Payments increase dramatically. And many buyers suddenly find themselves priced out. Consider a simple example. A buyer who could comfortably afford a home at a 3% mortgage rate might face a drastically different reality at 7%. The monthly payment could increase by hundreds of dollars, sometimes even more. For many households, that change alone is enough to stop the search entirely. They pause their plans. They renew their lease. They wait. And when millions of buyers make that same decision, demand disappears. This is why rising rates can cool the housing market so quickly. It's not just about prices. It's about payments. Even if home prices stay the same, higher borrowing costs can make those homes effectively unaffordable. And that's exactly what many buyers are experiencing today. The math simply no longer works. But rising rates create another unexpected consequence. They trap existing homeowners. Millions of homeowners locked in historically low mortgage rates during the boom years. Some secured loans near 3%. Others even lower. And that creates a powerful incentive to stay put. Why sell a home with a 3% mortgage, only to buy another home at 7%? For many families, the answer is simple. They don't. They stay where they are. This phenomenon has created an unusual situation. Supply remains limited in some markets, but demand has weakened. The result is a strange kind of stalemate. Buyers are hesitant. Sellers are reluctant. And the market moves slowly. Yet beneath this calm surface, pressure continues to build. Because not all sellers have the luxury of waiting. Some need to move for work. Others face financial pressures. Investors may decide to exit. And when those sellers enter a slower market, they face a new reality. They must compete. Price becomes the most powerful tool. And when one seller cuts the price, others soon follow. This is how price trends begin to change. Not with a dramatic crash, but with a steady sequence of reductions. First $5,000, then $10,000, then $20,000. Gradually, the direction becomes clear. The market is adjusting, and buyers watching from the sidelines start to notice. But instead of rushing in, they wait even longer, because falling prices reward patience. This dynamic can create a feedback loop. Buyers wait for better deals. Waiting reduces demand. Lower demand pushes prices down. And falling prices encourage even more waiting. It's a cycle that can reshape entire markets. And once it begins, it can take years to fully play out. But perhaps the most important factor in housing is something less measurable. Confidence. Housing markets thrive on confidence. Confidence in the economy. Confidence in jobs. Confidence in future income. When confidence fades, demand fades with it. And rebuilding that confidence can take time. Right now, many buyers are standing at the edge of the market, watching carefully. They are studying trends, tracking mortgage rates, monitoring price reductions. They are not rushing. They are observing. And their patience is quietly transforming the housing landscape. But the story becomes even more complex. Because the housing market is not just about buyers and sellers. It's also about investors, large institutions, short-term rental owners, and speculative buyers who once saw housing as a fast path to profit. And when those players start to rethink their strategies, the entire market can shift again. In the next part of this story, we'll explore that side of the equation. The investors who helped drive the housing boom, why some of them are beginning to step back, and how their decisions could amplify the changes already unfolding across the market. Because when investors retreat at the same moment, buyers disappear. The impact can be far greater than anyone expects. For years, investors were one of the most powerful forces in the housing market. In some cities, they weren't just participating. They were dominating. During the housing surge between 2020 and 2022, institutional investors and small-scale property buyers purchased massive numbers of homes. Single-family houses became investment assets. Rental demand was strong. Prices were rising quickly. And borrowing money was cheap. For investors, the opportunity seemed obvious. Buy homes. Rent them out. Watch values climb. But markets never move in only one direction. And when conditions begin to change, investors often react faster than traditional buyers. Because for them, housing is not just a place to live. It's a financial calculation. To understand why investors entered the market so aggressively, we need to look at the environment that existed just a few years ago. Interest rates were near historic lows. Large investment firms could borrow billions at extremely low cost. At the same time, demand for rental housing was surging. Millions of people delayed buying homes and chose to rent instead. That combination created ideal conditions. Low financing costs, rising rents, and rapidly appreciating property values. For investors, it felt like a perfect equation. But that equation has started to change. Borrowing costs are no longer cheap. Interest rates have climbed dramatically. For investors relying on financing, the numbers look very different today. Higher rates mean higher expenses. Profit margins shrink. Deals that once looked attractive suddenly appear far less appealing. And when profit disappears, investors step back. This shift is already visible in many markets. Institutional buying activity has slowed compared to the peak years of the housing boom. Some investors are becoming more selective. Others are pausing acquisitions entirely. But perhaps the most important question is not about buying. It's about selling. Because when investors decide to exit, the impact can be significant. Real estate markets are sensitive to changes in supply. When new listings increase, buyers gain leverage, and investors can introduce supply very quickly. Unlike homeowners, investors often treat properties as financial assets. If market conditions weaken, selling becomes a strategic decision. Protect the profit. Limit potential losses. Move capital elsewhere. History offers clear examples of this behavior. During previous housing downturns, investor-heavy markets experienced sharper swings. When prices were rising, investors accelerated the growth. But when the cycle turned, those same investors amplified the decline. The housing crisis of 2008 revealed this pattern clearly. Cities with high levels of speculative activity saw dramatic price drops once investors rushed for the exits. Again, history does not repeat perfectly, but the pattern remains relevant. Today, many investors are watching the same signals buyers are watching. Rising inventory, longer selling times, more frequent price reductions. These signals matter because real estate investors often operate on expectations. If they believe prices will keep rising, they buy aggressively. If they suspect prices could soften, they slow down. And sometimes they sell. Another factor complicates the situation. Short-term rentals. Platforms that allow homeowners to rent properties to travelers transformed the economics of certain housing markets. In many tourist destinations, short-term rentals generated significantly higher income than traditional long-term leases. That opportunity attracted thousands of investors. Homes were purchased specifically to operate as vacation rentals. But short-term rental markets can change quickly. Local governments sometimes introduce regulations. Tourism demand fluctuates, and economic slowdowns can reduce travel. When those factors shift, the income projections that once justified high purchase prices may no longer hold. For some investors, that realization leads to a difficult choice. Continue holding the property or sell. If enough investors reach the same conclusion, the effect can ripple through local markets. New listings appear. Competition among sellers increases. Prices become more flexible. Buyers gain leverage. But again, something unusual is happening in today's market. Even as leverage shifts toward buyers, many are still hesitant to act. They're waiting, watching, trying to determine where prices may go next. This cautious behavior can create a prolonged adjustment period. Unlike sudden crashes in financial markets, housing corrections often unfold slowly. Prices soften gradually. Inventory rises steadily. Confidence erodes step by step. The shift feels subtle at first, until suddenly everyone recognizes the change. And perception plays an enormous role in housing. If buyers believe prices might fall 10%, many will wait. If they believe prices might fall 20%, even more will stay on the sidelines. That expectation alone can reshape demand, because housing markets depend on participation. When large numbers of buyers withdraw, the market loses momentum. Yet not every region will experience the same outcome. Some areas still have strong population growth. Others face severe housing shortages. Local economies differ. Job markets differ. And those differences matter. Real estate is always local. But even strong markets can feel the effects of a national shift in psychology. When headlines begin discussing slowing sales and falling prices, the narrative spreads. And narratives influence decisions. Today, the narrative is beginning to change. For years, the dominant story was simple. Buy now or be priced out forever. But now another message is emerging. Wait. Watch. Opportunities may appear. That change in mindset may be one of the most powerful forces shaping the housing market right now. But the story still isn't complete. Because the housing market isn't just reacting to buyers and investors. It's also responding to broader economic forces. Inflation, interest rates, employment trends, government policy. All of these elements interact in complex ways, and their combined influence will determine what happens next. In the final part of this story, we'll step back and look at the bigger picture. Why the current shift may take years to fully resolve. What it means for sellers trying to navigate the new market. And why the housing market, despite every cycle and every correction, remains one of the most powerful forces in the global economy. Because even when buyers walk away, the housing story is never truly finished. Housing markets rarely collapse overnight. Instead, they evolve. Quietly, gradually, almost invisibly at first. Then suddenly, the change becomes undeniable. And that is where many housing markets appear to be today. Not in chaos, not in collapse, but in transition. For sellers, this transition can feel confusing. Only a short time ago, the rules were completely different. Homes received multiple offers within days. Prices surged above asking. Buyers competed aggressively. In many cases, sellers held all the power. But markets do not stay unbalanced forever. Eventually, conditions begin to normalize. And when that happens, expectations must adjust. One of the most difficult adjustments for sellers is psychological. When a neighbor sells their home for a record price, that number becomes a benchmark, a reference point, a belief about what a property should be worth. But when the market changes, those reference points lose their power. Yesterday's record sale does not guarantee today's price. And accepting that reality can be difficult. Some sellers resist lowering their expectations. They keep listings active. They wait for the right buyer. But sometimes that buyer never arrives. At the same time, buyers are approaching the market with a completely different mindset. Instead of urgency, they feel patience. Instead of competition, they expect negotiation. Instead of fearing higher prices tomorrow, they wonder if prices might be lower next year. That shift in mindset is powerful, because housing markets depend on confidence and momentum. When momentum disappears, the pace slows dramatically. But the housing market is not just about psychology. It's also about demographics. And demographics move slowly but steadily. Over the coming decade, millions of younger households will reach prime home buying age. At the same time, many older homeowners may begin downsizing or relocating. These forces will continue shaping housing demand, which means the long-term story of housing is far from over. However, the path between today and that future may not be smooth. Periods of adjustment can last years. During those periods, prices may stagnate. Some markets may experience declines. Others may simply move sideways. And buyers and sellers will gradually rediscover equilibrium. Government policy will also influence what happens next. Interest rates, housing supply programs, tax policies, regulatory changes. All of these decisions can affect affordability and demand. In past housing cycles, government intervention often played a major role in stabilizing markets. But policies rarely create instant solutions. Housing imbalances take time to resolve. One of the biggest challenges remains supply. In many countries, housing construction has lagged behind population growth for years. Shortages in some regions remain severe. Even as buyer demand slows, the structural need for housing has not disappeared. This tension creates a complicated dynamic. Short-term weakness combined with long-term demand. That's why housing cycles rarely follow simple narratives. There is no single moment when the market suddenly crashes. Instead, there are phases: boom, stability, correction, recovery, and every cycle reshapes expectations. For buyers who stepped away from the market, patience may eventually create opportunities. More inventory, more negotiation power, more flexibility from sellers. But timing any market perfectly is nearly impossible. And that uncertainty keeps many people waiting longer than expected. For sellers, adaptability becomes the most valuable strategy. Pricing realistically, understanding market conditions, and recognizing that the environment has changed. Those who adjust quickly often succeed. Those who resist the shift sometimes face longer waits and deeper price reductions. Yet through every cycle, one truth remains constant. Housing is not just an investment. It is where people live, where families grow, where communities form. And that fundamental reality gives the housing market its resilience. Even during slowdowns, life continues. People relocate, families expand, jobs change, and homes are bought and sold. Still, the current moment carries an unmistakable signal. The era of effortless bidding wars has faded. The frenzy has cooled, and buyers who once rushed into the market are now stepping back. Watching, calculating, waiting. That patience is quietly rewriting the rules of the housing market. Sellers must compete again. Prices must reflect affordability. And the balance between supply and demand must slowly rebuild itself. It may take months. It may take years. But eventually, every housing cycle finds its equilibrium. And when historians look back at this moment, they may describe it not as a dramatic crash, but as a turning point. A moment when the unstoppable momentum of the housing boom finally slowed. When buyers regained caution. When investors reconsidered their strategies. And when the market once again began to reset. Because in real estate, power constantly shifts. Sometimes it belongs to sellers. Sometimes it belongs to buyers. But the market itself remains the ultimate force. Patient, persistent, and in many ways, untouchable.